Hey everyone, Anthony Venuto with InTouch Mortgage Solutions. On this episode, we're going to be talking about our monthly mortgage rate update. Where are rates today? Where were they just a few months ago? And what should we be paying close attention to when we're selecting our mortgage rate and product? Stay tuned, you don't want to miss it. Once again, welcome back to Finance Fridays episodes. I'm Anthony Venuto, your host, and on this episode, we're going to be talking about fixed rate mortgages for the month of August. Where are interest rates headed? What are the interest rates looking like for today for several different fixed rate products? And obviously on our monthly mortgage rate update, we're going to have a little bit of insight on what the differences are in those products. Once again, if you're new to the channel, we invite you to subscribe. Make sure to hit that notification bell and leave us a comment or question in the question and comment section below. And we will be sure to address them in future episodes as we will be doing a question and answer video in the coming weeks. Obviously, with interest rates right now, as the bond market continues to surge higher, obviously as an impact of the economic data that is coming out from different segments, obviously as economic conditions change, GDP growth, unemployment, salary, wages, all these things impact not only the Bank of Canada's decision come September, it also influences the bond prices. Bond prices are directly related to fixed rate mortgages. And for many Canadians who might be approaching either mortgage renewal, maybe they have a pre-approval with an existing rate that might be close to expiry. What do you do in a situation like this? Obviously, if you don't execute on that expiry date, will you have to requalify? Yes. Will that mean that your qualification could change? Absolutely. If interest rates are higher, well, under the current stress test rules, you need to qualify under the current rates. And some of these rates have gone up significantly, meaning it could potentially reduce your purchasing power on your mortgage if you're looking to buy. And obviously, if you're coming up to mortgage renewal, well, with higher interest rate means higher mortgage borrowing costs, which means less disposable income, less money left over at the end of the month. And although that is what the Bank of Canada wants when they want to talk about monetary policy and how to impact spending. Now, once we jump into these rates, I want to point out there are differences in not only the rates, but the types of products and what you can and cannot do with some of these products. We get questions all the time when we see these rates online. Obviously, it's very enticing, but there are limitations and stipulations when it comes to these particular products. Let's start off with insured mortgages. These are generally the cheapest type of mortgages that you will see online advertised, but there are specific limitations when it comes to insured mortgages. Number one, obviously, is the maximum purchase price, which is sub 1 million. Obviously, amortization, 25 years. You have to pay the default insurance premium on these products, which means depending on how much money you put down, well, that will determine how much of a premium you are paying through either Canada Mortgage and Housing Corporation, CMHC, Sagan, or Canada Guarantee. There are 3 insurers in Canada. All of them have the same premiums and the same rates, so there is no difference between them. Obviously, with these particular insured products, there are stricter guidelines when it comes to qualification and your debt servicing ratios. Those numbers are very important to understand. So now if we shift over to insured and insurable products or switch and transfer products, it's important to understand that these are for purchases as well. You cannot refinance on these particular products. It is for purchases that are also sub 1 million. Maximum amortization is 25 years. You can't take less. And depending on the amount of your deposit or the evaluation or loan to value on your home, how much the home is worth as opposed to the mortgage amount, well, you can get a different rate based on that parameter. So it's important to understand that. For default insurance premiums, you are not required to pay because you are putting 20% or more down. The lender usually pays for this particular cost when getting these better interest rates than are offered on a conventional 30-year option. And we'll get into that in just a moment. Obviously, with the insured switches and transfers, these are insurable products, means you cannot refinance. So you can only take your existing mortgage balance from one lender and transfer it over to another lender. And generally, you're going to get a more advantageous rate, but it has to be 25 years or less amortization. And the valuation of that home has to be sub 1 million for qualification purposes. There are certain parameters certain lenders do offer, depending if it's a collateral or standard mortgage, they do offer products to cover the cost for that switch or transfer, and you are able to cap a certain amount of the cost into the mortgage amount. But remember, it's not for refinances. If you're looking to refinance, take out equity, maybe you're purchasing over $1 million, you need the 30-year amortization because that extra 5 years is going to give you some additional cash flow, help you with your household finances. Well, obviously this is the conventional mortgage. This is obviously for $1 million or more, 20% or more down is required. No default insurance premium is added. And there are often some exceptions that can be done when it comes to those debt servicing ratios, as these mortgages are generally on the bank's balance sheets and they are the ones that are administering them, and they have to be very cautious on how they approach each particular deal. So you can see that there are 3 different components: insured and insurable, insured switch and transfers, no refinances, purchase only, conventional refinance, equity takeouts. There's obviously lines of credits. And on this episode, we're not going to be diving too much into line of credits or into variable rate mortgages. Variable rate mortgages are a product that obviously require a lot of attention in this current market. So speaking to your mortgage professional, if you're contemplating the benefits, the pros and cons of a variable product, speak to a mortgage professional, make sure you understand the types of products, if it's adjustable, if it's a static payment with a trigger rate, what your prepayment privileges are, what your exit strategies are, and what those penalties could look like in this environment with higher interest rates. Speak to a mortgage professional, get the right advice on that. It can help keep thousands of dollars in your pocket. So now let's dive into the first bucket, is obviously the insured mortgages. As I mentioned earlier on, these are the cheapest available. These are oftentimes the ones that are advertised, and although there can be some variance, obviously there are in those particular rates, if you read the fine print, subject to approval, subject to conditions apply. Obviously a lot of times these campaigns run, and those rates that you might see are bait and switches. I have looked at it. Some clients have called me. I'm like, yeah, that rate no longer exists. We've reached out to those lenders. It's like, yeah, that is an old promotion. So just be very cautious when you are shopping online, and what you're being offered. Some of these products may have a bona fide sale clause, means you can't refinance. Even if you want to pay the penalty, you can't. You have to sell the home. Obviously, your prepayment privileges may be non-existent. So if paying down your mortgage, taking advantage of those higher prepayment privileges are important, you want to make sure that you pay close attention to those options. Don't just get blinded by the rate. Understand the product, because it's equally as important, especially if interest rates come back down. At some point, the penalty gets even more expensive on those products. So 5 years, starting off 5.39% with an insured mortgage. Now, insurable products, switch or transfer, starts at 5.39%. If you're putting 35% or more down, for example, if you're putting, let's say, just the 20% down, then you might be at the higher end of that spectrum at 5.89%. For a conventional rate mortgage, you're at 5.84%. So if you're going into a conventional, it's 5.84%. Now, a 4-year starting at 5.69 as we start to get a little bit more expensive, as the contract year term starts to get a little bit shorter, depending on how you look at these bond yields. Obviously, the lower, shorter term mortgages are more expensive. So 5.69% starting, insurable starting at 5.69, depending on the down payment, or the equity loan to value, 6.24%. And we're seeing some of the best conventional rate mortgages, depending on the product. Maybe you have to open a bank account, maybe you have to do certain parameters to get these rates, but you can see 5.99 plus on some of these products. Now moving on to a 3-year, the reason why they're highlighted is because those are the 2 most common products. Starting at 5.84% for an insured 3-year. Now you're looking at 5.84 to 6.31 for an insurable switch transfer. The best 3-year that we're seeing right now for a conventional product is hovering around that 6.14%. Obviously now a 2-year getting a little bit more expensive. You're seeing 6.29%, going anywhere from 6.29 to 6.79%, depending once again on those premiums. Obviously the amount of money you're putting down, loan to value. The best conventional purchase that we're seeing right now for a 30-year amortization on a 2-year product is 6.59%. 1 year, 6.74, really expensive for a 1-year product nowadays. 6.74 to 704, best conventional purchase 1 year, 704. So obviously you can see that there's a wide range in there of the rates and products, and when clients are going in to review their options, obviously the higher the rate, the more stringent the qualification. So if you were looking at a 1-year conventional as opposed to a 5-year conventional, that spread between 5.84 and 7.84 could mean a substantial amount of purchasing power. And this is what we're finding happening right now, where a lot of Canadians who wanted maybe the 3-year, but at 6.14%, let's say on a conventional, to 5.84 means that they may not get the home that they're looking for. So they're maybe forced into taking a longer term. Whether the banks understand this or know this or sort of the culprit, obviously if interest rates come down, those penalties, looking at all these things, it's very important to speak to a mortgage professional about your options and trying to get that qualified. Remember, with some conventional rate mortgages, there could be some capacity for an exception to be had on the final product. Now, as rates continue to move, as the bond prices continue to change, we'll start to track these rates. And we have been, for those viewers that have been following us, we do these monthly rate reviews where we look back and see exactly where rates are. And if you look back at a 5-year insured mortgage in March, it was at 4.64. It dipped down to around 4.39 and a little bit lower in most of May, and then started to tick back up in June. As you'll see with most of these products, it went up to 5.39% as of August. And obviously, if the bond prices change, so do the rates. So they are obviously subject to change. 5-year conventional mortgage was starting at 5.14% back in March. Fast forward, we're now at 5.84%. And a 3-year insured started at 4.99 back in March. As I said, most of them dipped in May, and now we're at 5.84% in August. So we can see that we've sort of gone through these ebbs and flows when it comes to these particular rates. And the 3-year conventional 5.14, now it's 6.14, a full 1% difference in the last few months. So obviously tracking these rates are very important to understand where things are headed. And obviously if you have questions about your particular mortgage, or you want to have a conversation about your mortgage renewal pre-approval, obviously feel free to reach out to our team here at InTouch Mortgage Solutions. We're always here to help and provide some guidance. But we want to leave the video here. Let us know in the comment sections below where you think interest rates are headed. What do you think is going to happen with the bond prices? Are we going to see double-digit interest rates? Is the Bank of Canada going to make a move in September? Are they going to pause? Are they going to hike? Let's find out what the economic data tells us, and we'll be tracking that on the channel. So make sure you like and subscribe. Don't forget to hit that notification bell. Leave those questions in the comment section below. And if you learned something on this video, or you know someone that could benefit from this content, make sure you share the video with a friend. But we'll leave the video here, wishing everyone a wonderful Friday, and more importantly, a better weekend ahead. We'll see you next week. Thanks for clicking.